You're doing everything right. You've got a savings account. You're putting money away every month. You're being responsible. And every year, your bank sends you a little notification your savings grew. What they don't tell you is that you're probably getting poorer anyway, not because you spent too much, not because of bad luck, but because the system your money is sitting inside was never designed to make you wealthy. It was designed to make sure you feel like you're okay, while something else quietly drains you from the other side. Let's talk about what's actually happening. Right now, the average savings account in the United States pays somewhere around 0.4% interest annually. High-yield accounts at online banks get you closer to 4% or 5%, which sounds better. And for a moment, it almost feels like the system is working in your favor. But here's the number that doesn't make the headline: inflation. Over the last century, inflation has averaged roughly 3.3% per year. Some years it's quiet, barely noticeable. Some years, like 2022, it hits 9%, and everyone suddenly starts caring about economics. Either way, it never stops. It doesn't take weekends off. It doesn't pause because the market is uncertain or because you're going through something difficult. It runs, constantly, in the background of every dollar you own. Here's the math that banks hope you never sit down and do. If your savings account pays you 0.4% and inflation runs at 3%, you're not gaining 0.4%. You're losing 2.6% of your purchasing power every single year, silently, automatically, without anyone's signature on a document. Your balance goes up. Your wealth goes down. These two things can both be true at the same time, and the bank statement will only ever show you one of them. This isn't a glitch. It's the architecture. To understand why, you have to understand what a bank actually does with your money. When you deposit $10,000, the bank doesn't lock it in a vault with your name on it. They lend most of it out to homebuyers, businesses, credit card holders at interest rates that can run anywhere from 7% to 29%. They pay you 0.4%. They collect 20%. The spread between those two numbers is the business. You are not the customer. You are the product. This isn't a conspiracy. It's just how fractional reserve banking works. The bank needs your deposits to function, and the cheapest way to keep those deposits is to make you feel safe, not to actually pay you what your money is worth. Now, central banks play their own role in this, and it's a bigger one than most people realize. When the Federal Reserve sets interest rates, they're essentially setting the floor for what money costs across the entire economy. Low rates stimulate borrowing and spending. They also punish saving. That's not a side effect. That's the mechanism. The Fed wants money moving, not sitting. A nation of cautious savers is, from a macroeconomic standpoint, a problem to be solved. For most of the 2010s, the Fed held rates near zero. Savings accounts paid virtually nothing for over a decade. Anyone who parked money in a savings account during that period and thought they were being smart, they watched inflation silently eat into it, year after year, while asset prices, stocks, real estate, anything with scarcity, went vertical. The people who understood the game move their money into things that inflate with the money supply. The people who didn't kept getting those little bank notifications that said your savings grew. And this is where it gets uncomfortable. Because the advice most people receive saves. Your money. Be responsible. Don't take risks is technically correct and structurally harmful at the same time. Saving is necessary, but cash sitting still is not neutral. In an inflationary system, doing nothing is a decision with consequences. The bank isn't lying to you. The interest is real. The statement is accurate. But the frame around it is missing, and that missing frame costs ordinary people, on a long enough timeline, an extraordinary amount of money. Consider this. If you kept $50,000 in a standard savings account for 20 years at 0.4%, you'd end up with roughly $54,000. Sounds fine. But if inflation averaged just 3% during that same period, the purchasing power of that $54,000 in today's terms would be closer to $29,000. You'd have more dollars and less money. So here's the question worth sitting with, and there's no clean answer to it. If the system that tells you to save also makes saving quietly ineffective, who exactly is the system designed to serve? Your bank has a very good answer to that question. I'm not sure you'll like it,